The perceived banking crisis and new indicators have financial experts trying to forecast the state of the economy.
That's right. The latest inflation numbers are still high, but indicate that the rate of inflation is cooling off some. The consumer price index climbed 0.4% in February, and inflation is up 6% from the same time last year. Meanwhile, regional bank stocks are trying to rebound today. They were, of course, hit hard by the shockwaves of Silicon Valley Bank and Signature Bank failing. Many other regional banks had to halt trading yesterday after their stocks tanked. We'll have more on the bank situation in just a moment, but first we want to talk more about those new CPI numbers.
And for that, let's bring in Greene. She is a senior fellow at Brown University and a global chief economist at Kroll. Megan, thanks for being with us. President Biden responded to the latest CPI report by focusing on job growth and low unemployment. Now, the president said he will, quote, continue working to lower costs for hardworking Americans. So what does this report really say about the state of our economy?
So the ultimate message is that inflation is still really high, much higher than the Fed's target of 2%. It's coming down, so peak inflation is behind us. But it's stubbornly high, and that's a reflection of the economy holding up really well in the face of aggressive rate hikes by the central banks. So the economy is actually doing pretty well. The downside to that is that means there's still a lot of demand in the economy, and that's partly what's pushing up prices still. So peak inflation's behind us, but prices are continuing to rise.
So with all of that, with peak inflation hopefully behind us, how does the CPI report and the recent bank failures especially play into the Fed's decision on interest rates next week?
I think that the bigger impact will be from the CPI report, and it just suggests that the Fed's job isn't done in terms of leaning against inflation. Yes, inflation's coming down, but it's stubbornly high. That suggests that the Fed is going to hike rates at its next meeting, I think probably by 25 basis points. The bank instability feeds into the Fed's decision insofar as you might think that the bank instability was actually the Fed's fault. And I don't think that's the case, really. I think, the banks that failed over the course of the past few days were pretty idiosyncratic. They had really select clientele that were unusually exposed to interest rate risk. So I don't think that we can assume that the banking system broadly was in trouble because of what the Fed's doing. If I'm wrong and we were to assume that, then the Fed might think about backing off.
Yeah.
But actually, what policymakers announced over the weekend has been enough to stem contagion from the instability that we've seen. And so I don't think it will feed much into the Fed's decision.
You talk about this notion of stemming contagion. What about other financial sectors, though, Megan? Could the loss of value in bank stocks potentially impact things like mortgage rates?
So it will tighten financial conditions more broadly. And for banks in particular, it means that their lending standards might tighten a bit. And so that could have implications on mortgage rates. It could push them up a little bit. But of course, mortgage rates are going to go up anyhow, if I'm right, and the Fed continues to hike rates.
All right. Well, Megan, thank you so much for joining us. We appreciate it.